If you're an Australian who's been putting off investing because the stock market seems too complicated, this video will change that. In the next 10 minutes, you'll learn exactly how to start investing in stocks, even with zero experience. I'll show you the step-by-step process, the best platforms to use, and the simplest strategies that actually work. No jargon, just practical advice you can use today. Let's start with the basics. A stock is simply a small piece of ownership in a company. When you buy shares in Commonwealth Bank, you become a part owner. Companies sell shares to raise money, and you benefit when the company grows. You make money two ways: capital growth when the share price increases, and dividends, which are cash payments companies make to shareholders. Australian companies are particularly known for paying strong dividends, and we have a special tax system called franking credits that makes dividends even more attractive here. Why invest in stocks instead of just saving? The Australian stock market has historically returned around 9 to 10% annually over the long term, while savings accounts give you around 4 to 5%. That difference is massive over time. $10,000 at 5% for 30 years becomes $43,000. At 10%, it becomes $174,000. That's the power of compound growth. Yes, stocks go up and down more than savings accounts, but over long periods they consistently outperform. Before you invest a single dollar, make sure you have the right foundation. You need an emergency fund covering 3 to 6 months of expenses in a savings account. Pay off high-interest debt like credit cards first, because paying 18% interest makes no sense when investments might return 10%. Only invest money you won't need for at least 5 years, because the market can be volatile short-term. If you're saving for a house deposit in 2 years, keep that money in savings, not stocks. How much do you need to start? The good news is you can start with as little as $500 to $1,000 on modern platforms. Traditional brokers might charge $10 per trade, so investing smaller amounts means fees eat into your returns. A good rule is to invest at least $1,000 per trade, or use platforms with lower fees for smaller amounts. Many successful investors started small and built wealth through regular monthly contributions. Now, let's talk about actually buying stocks. First, you need a brokerage account. Popular options for Australian beginners include CommSec, which is user-friendly and owned by Commonwealth Bank. Self-Wealth offers flat-fee trading regardless of investment size. Stake is great for both Australian and US stocks. CMC Markets has competitive pricing, and Perla is designed for long-term investors. Compare the fees and features to find what suits you. Opening an account takes about 15 to 30 minutes online. You'll need your tax file number ID, like a driver's license, and bank account details. Once approved in 1 to 3 days, transfer money from your bank into your brokerage account. Then you're ready to buy. Search for a company using its ASX code, like CBA for Commonwealth Bank or BHP for BHP Group. Every company has a unique 3 or 4-letter code. Click Buy, enter how many shares you want, and the platform shows the total cost including fees. A market order buys at the current price immediately. A limit order lets you set your maximum price. For beginners, market orders are simpler for established companies. Here's the most important part. What should you actually invest in? Don't try to pick the next big winner or chase hot tips. That's how beginners lose money. Instead, start with ETFs or exchange-traded funds. An ETF is a basket of stocks bundled together. When you buy one share of an ETF, you own tiny pieces of hundreds or thousands of companies. This gives instant diversification, spreading your risk instead of betting everything on one company. The most popular Australian ETF is VAS, the Vanguard Australian Shares Index, which holds 300 of Australia's largest companies. A 200 is another great option, tracking the ASX 200 with very low fees. For international exposure, consider VGS, which invests in major companies worldwide, or NDQ for US tech companies like Apple and Microsoft. Many experts recommend splitting your money between Australian and international shares, like 60% VGS, with just 2 ETFs. You achieve massive diversification across hundreds of companies globally. If you want to buy individual company shares, stick to businesses you understand with proven track records. The Big Four banks, BHP, Rio Tinto, Woolworths, Coles, and Telstra, are examples of stable blue-chip stocks. Avoid investing based on social media tips or because a friend said a stock will skyrocket. Do your own research and only invest in businesses you understand and believe in long-term. Let me share the 3 most important strategies for success. First, think long-term. The market fluctuates daily, but over 10, 20, or 30 years, it trends upward. Don't panic when your portfolio drops. If you invested during the March 2020 crash and held on, you'd have seen huge gains. If you panic sold at the bottom, you locked in losses. Time in the market beats timing the market. Second, use dollar-cost averaging. Invest a fixed amount regularly, like $500 every month, regardless of whether the market is up or down. When prices are high, you buy fewer shares. When prices are low, you buy more. This averages out your cost and removes the stress of trying to time the perfect entry point. Set up automatic transfers to make investing a habit, not something you do sporadic. Third, diversify it. Don't put all your money in one stock or sector. Spread across different industries like banks, miners, tech, healthcare, and retail. Also diversify geographically. Australia is only 2% of the global market, so international exposure protects you from relying entirely on our economy. ETFs make diversification easy, but even with individual stocks, aim for at least 10 to 15 companies across various sectors. Understanding Australian taxes is crucial. Dividends are taxable income you declare on your tax return. Capital gains from selling shares are also taxable, but if you hold shares for over 12 months, you get a 50% discount. Only half your gain is added to taxable income. This encourages long-term investing. Your broker provides tax statements each year showing all dividends and sales, making tax time easier. Avoid these common mistakes. Don't invest money you need soon or can't afford to lose. Don't wait for the perfect time to start because you'll miss out on gains while waiting. Don't panic sell during downturns. Don't chase hot tips or try to get rich quick with speculative stocks. And watch out for fees, because frequent trading and high management fees erode returns over time. Favor low-cost ETFs with management fees under 0.3% annually. You don't need to check your investments daily. Review your portfolio quarterly or twice yearly. Check performance, ensure your allocation matches your goals, and rebalance if needed. If you wanted 50-50 Australian and international shares, but Australian has grown to 60%, sell some Australian and buy international to restore balance. Keep learning through books like The Barefoot Investor. Join online investing communities and follow reputable Australian financial sources. Don't forget about superannuation. Your employer contributes to your super, and you can add extra. Super has huge tax advantages, with contributions and earnings taxed at just 15% instead of your marginal rate. You can't access it until around age 60, but it's one of the most tax-effective wealth-building tools available. Make sure your super is invested appropriately for your age. Younger investors can handle more growth assets like shares. Here's your action plan. First, ensure you have an emergency fund and no high-interest debt. Second, open a brokerage account on a platform that suits you. Third, decide your strategy, whether a simple ETF portfolio or a mix of ETFs and individual stocks. Fourth, make your first investment to get started and learn by doing. Fifth, set up automatic monthly contributions. Sixth, commit to your long-term plan and avoid emotional decisions based on short-term market movements. Investing in stocks is one of the most powerful wealth-building tools available. While it seems intimidating initially, thousands of Australians have learned successfully, and you can too. Start small, stay consistent. Think long-term, and watch your wealth compound over time. The best time to start was yesterday. The second best time is today. Even small amounts invested regularly can grow into substantial wealth over decades thanks to compound interest. If this video helped you, hit the thumbs up button and subscribe for more Australian investing content. Drop a comment with your questions or share if you've started your investing journey. Thanks for watching, and remember, the hardest part is taking that first step. Once you make your first investment, you'll wonder why you waited so long. I'll see you in the next video where we'll explore how to build a complete investment portfolio. Until then, happy investing.